Hey guys, welcome back to the channel. So, a lot of people, they're really into, investing, but they don't really know what they want to invest in. So they take the safe route, right? They invest in ETFs, right? Exchange traded funds, or maybe they invest in broad indexes, stuff like that. But I want to talk about ETFs, more specifically ETF dividends, right? How they're going to be taxed, right? Because you might be surprised, or maybe you already know, or maybe you're just curious, right? But I want to talk about them because ETFs, right, are taxed in the same way as their underlying assets would be taxed, right? Basically, what this is going to mean is like if an ETF has all stock holdings, it gets taxed just as the sale of those stocks would be taxed, right? So then, if you hold an ETF for more than a year, then you would pay capital gains tax, right? If you hold it for less than 1 year, any profits will be treated as ordinary income. The only exception is precious metal ETFs. So, if you have a precious metal ETF, right? If it if that precious metal ETF actually holds precious metals, then the ETF will be taxed as a collectible, which means it will be taxed at a maximum 28% rate. However, this is still bad news for mm, most investors, right? So then let's move into talking about qualified dividend taxation, right? Because, we got to first establish that ETFs holding stocks usually pay dividends once a year, and ETFs holding bonds usually pay interest monthly. Now, if you're investing in an ETF that holds stocks, then you want to make sure it's paying qualified dividends, right? Qualified dividends must be paid by an American company or a qualifying foreign company. They must not be listed as an unqualified dividend with the IRS. And the holding period must have been met, right? So, to receive this, right, to receive a qualified dividend, you must hold an ETF for more than 60 days before the dividend is issued, right? So, hold the ETF for more than 60 days before that dividend gets issued, right? So if it's issued once a year, right, you would need to buy it about at least 61, 62 days before like, the end of the year or whenever it is that payment date is, right? So the current tax rates on qualified dividends are 0%, 15%, and 20%, depending on your filing status and tax bracket. Now, if you hold an ETF for fewer than 60 days, then those dividends are going to be taxed as ordinary income. All dividend income will be reported on it's a form. It's called 1099-DIV, right? Dividend DIV, right? So if it's fewer than 60 days, ordinary income. More than 60 days, right? That's how it'll be a qualified dividend, and the tax rates are 0%, 15%, 20%, right? So then, well, then let's talk about some some potentially safe ETFs with pretty good yields. I'm not gonna go over a bunch of them, right? I don't want to be here all day because, I'm sure there's more, but just a couple because, no investment's bulletproof, right? Um, if the stock market holds up, as a lot of people think, um, then stuff like a PFF, right, which is iShares U.S. Preferred Stock, which tracks the performance of the S&P U.S. Preferred Stock Index, would be an option that you would think about. So as an ETF, the first thing you want to look at is the expense ratio, right? Well, in this case, it's 0.46%, which is a little over the average ETF expense ratio of about 0.44%. So that iShares U.S. preferred stock, ticker symbol PFF, as of October 15th of 2021, it yields 5.11%. That's not bad. It's not bad. The same warning, though, is going to apply to Wisdom Tree total dividend ETF, right? And the ticker symbol for this is going to be DTD, right? And this ETF tracks the performance of the Wisdom Tree Dividend Index and comes with an expense ratio of only 0.28, right? And then it comes with a distribution yield of about 2.31%, right? So one's got a little bit higher expense ratio, but a much better yield. And the other one's got a much lower expense ratio, but it's also got, it's got half the expense ratio, but half the yield. With the old saying, right? More risk, more reward, right? So it's just something to keep in mind. You know, Even if you don't want to get into ETFs, I know a lot of people get in ETFs because they're fairly safe. And if you don't really know too much about like how ETFs are like bundled, how they work, I do have a previous video that you guys can go look at, right? But let's wrap this up. I want to keep this short for you guys. I want to keep you here all day. What's the bottom line? Like, what does this all mean? Well, tax obligations for ETF dividends, it really depends on whether or not they're qualified or unqualified, right? If they're unqualified, remember, they're going to be taxed at your normal income rate, right? Whatever your normal income rate is, whatever that tax bracket you fall into, that's how they're going to be taxed if they're unqualified dividends, right? Now, if they're qualified dividends, they'll be taxed between 0% and 20%. Remember, it's at 0%, 15%, or 20%, right? So it'll be one of those three if they're qualified dividends. Now, if you're looking for dividend paying ETFs to invest in, you can, look at the ones I listed above, right? You can use PFF or DTD, right? Which is the U.S. preferred stock, is ticker symbol PFF, and DTD is going to be the Wisdom Tree Total Dividend ETF, right? You can use these as starting points, right? But honestly, I say this all the time, you really need to do your own research on other ETFs that pay high dividends, right? Make sure to keep in mind you're looking at those ratios for the ratios for like how much they yield, the ratios for expense, right? Just anything that you can see in there, and just, you might even look at the companies in there, and you might not like one of the companies, right? Really dig into like what's in there and all that good stuff, right? I really hope you guys enjoyed this video, though. If you did enjoy this video, please give it a thumbs up. If you're not subscribed to the channel, I'd really appreciate it if you did. Until I see you guys in the next video, I hope y'all will be safe.